We've got K Ramanathan, CIO at ING Investment Management, who joins in live on Street View at lunch. Ram, always a pleasure chatting with you. What, according to you, explains the strength that we're seeing in our markets today? Do you think it's more of a short-term rally, largely on account of global cues, the fact that there's now a good chance that Fed tapering could get delayed a little longer than even December, maybe?
Yeah, that's right. Clearly, the incremental numbers in terms of job creation, whether it's the non-farm payrolls or the jobless claims, as well as, say, some profit warnings from Walmart, clearly indicate that the U.S. economy is not as robust as expected. Also, the U.S. government impasse is creating reason enough to believe that even if the Debt Ceiling Act is passed, given that there is a risk of this prolonged shutdown containing the possibility of the tapering is slightly far away than expected. Earlier it was September, then it got postponed to December, and now possibly it could well pan out into the next year also. So that gives breathing time, that gives time for stability to the rupee, more so when you're expecting $10 to $15 billion of FCNRB coming in. That should support the rupee significantly. And coincidentally, the oil prices have also come off. Brent from about 116 is around 108. Petrol prices have been reduced, so that is positive for inflation. And we need to yet see whether there is a sobering impact on food inflation, because the CPI has been reducing, not at the pace at which it should reduce, but hopefully with a good monsoon, if food inflation also subsides, then that will be positive for growth.
Ram, hi, afternoon. How are you looking to approach autos now post the monthly sales data? Some of them have been performing quite well, the likes of a Bajaj Auto or, for that matter, Tata Motors today.
See, from a two-wheeler, from a domestic perspective, possibly the growth beyond expectation is because of festive season stocking. So we need to yet see the retail sales numbers. The numbers which have come out are production growth or building up of inventory. From that point of view, I would be a bit cautious. From a portfolio perspective, we are underweight autos, but overweight Tata Motors.
What about the IT space? There's no stopping the rally there. One would have thought with the rupee strengthening, we could see a bit of a reversal as far as the fortunes of IT companies are concerned, but clearly not. There's strong demand. How does the sector look to you fundamentally, and how are you mapping the earnings season for IT companies?
Fundamentally, we are positive on the IT sector. In terms of the expectations, the rupee number which has been built in is 60 and not 65 or 68. So there should not be any scope for downgrades because of rupee being at 61 or 62. From a growth perspective, clearly the last quarter numbers indicate, as well as the feedback from the managements of IT companies indicate that growth is pretty robust. QOQ volume growth has ranged from 1.5% to 5% in the case of TCS. That robustness should continue. The feedback from management is extremely positive. A huge number of discretionary spends and amounts are expected over the next few quarters. That should again be positive for volume growth. And if you look at it from a relative perspective, from a PEG perspective, surely the IT stocks are cheaper compared to FMCG and pharma. So from a portfolio point of view, you need to be overweight this sector.
Ram, what according to you would be the biggest laggards this earnings season?
In terms of earnings growth, clearly the financial sector and the capital goods sector will be the laggards. One can always say that the valuations reflect that. So it's a question of expectations versus actual delivery. The result season clearly would also be looked at from a point of view of future outlook. What would be keenly watched is the management commentary of financials and capital goods in terms of improving outlook. From the recent numbers which came out on IIP and the core sector, there is some evidence that the degrowth has bottomed out. If you see, the IIP numbers are now clocking 1 to 2%. If one looks at the core sector numbers which have come out, clearly indicates that the latest IIP number could be around 3%. So degrowth is bottomed out. Whether that leads to a higher trajectory of growth, that's something which we would look at from the management commentary.
Let's briefly talk about the macros as well. Ram, other than the global cues, do you think domestic macros now are looking a little better than they did maybe 3 months ago, with the rupee having strengthened? And like you said, even the economy seems to have bottomed out a little bit, and expectations are that second half of the fiscal we're likely to grow at around the 5.5% mark.
Yeah, I would accept that fact that the macros, especially on the inflation front, especially on the subsidies, have reduced a little bit. One needs to see the tone of the next monetary policy, because while one thought the hardening of interest rates or the MSF increase was only based on the rupee depreciation and the need to stem the depreciation, one more angle which has come out is CPI inflation. Of course, we have a situation where the WPI inflation is 6%, your core inflation is 2%, and your CPI inflation is 8.5%. So clearly, we need to see what the governor on a sustainable basis looks at. And this is a wide range, core inflation at 2% and CPI inflation. If he looks only at, or if he tilts towards CPI inflation, possibly there could be another 25 to 50 base point rate hike. On CPI inflation, again, as I said earlier, we need to look at how the food inflation pans out given the good monsoon. I'm pretty sure the governor will also be looking at that.
Ram, so what according to you could throw up a positive surprise this earnings season? A lot of people have been talking about the cap goods space, the likes of a BHEL, or for that matter, metals like a Hindustan Zinc, which could be the surprise performer this earnings.
See, metals as a pack could positively surprise, because clearly the rupee depreciation has helped. In fact, net importers have turned net exporters. So we could have some amount of margin expansion. Also, some of these stocks had been beaten down quite a bit. Some of these stocks are 50-60% down. So they have rallied by 20-30% on an average over the past month. So that could be a positive surprise. Private sector banks also could positively surprise. Today, there are multiple worries for the private sector banking space. One, of course, the valuation of this space is much higher compared to the PSU banks. But at the same time, you're not going to have treasury profits. Possibly because of the short-term rate increase, you could have some margin pressures. And we need to see how their sparkling asset quality. I mean, so far, most of the private sector banks have very robust asset quality. Whether the prolonged slowdown would impact asset quality. So here, if we see that the result season throws up less worries on the asset quality, not that much margin pressure, then I feel the results could positively surprise. Because if you see the private sector banking space, people are now used to 25 to 30% year-on-year growth in earnings. If they exhibit similar trajectory, even despite all the problems, they could get re-rated again.
All right, K Ramanathan, we'll leave it at that. Thanks for joining in with that perspective.